Hello again, this is Alex with MasterChartsTrading.com, and this is market recap for Friday, May 26, 2017. So again, we see stocks setting fresh all-time highs, but on relatively thin volume. We'll look at breadth and pretty in detail. There are some breadth divergences that still remaining, but technology, industrials, utilities, and staples broke to fresh all-time highs. Retail still is lagging. We'll look at financials and do some candlestick analysis on that. S&P 500 broke above resistance 1 pivot, and QQQ actually broke above resistance 2 pivot. So all of this is bullish for stocks. I look at junk bonds. There's some strength in TLT and in the investment grade bonds. So I wonder what's happening there with stocks at all-time highs. We'll look at dollar. Gold had a very good week again, and this week we'll look at a little bit more detail at the picture in oil. We'll try to see some fundamental picture and of course technical as well. And this is kind of interesting development. BlackRock and Vanguard may push ExxonMobil for a climate stress test gauging impact of green technology on its assets. The S&P 500 ETF SPY Thursday here, fresh all-time highs. So this gap from last Wednesday, I believe, basically was completely negated. This is a very bullish development, and it's showing there's lots of resilience in the market. Additionally, this could be like a possible cup. So if this is indeed a cup and now we have a breakout, we can do a measured move. So it's about 3% from breakout. So we still have some ways to run if this is indeed a cup. So again, this is a very bullish for the general market. Now, my concerns remain the same and pretty much unchanged. Well, a little bit changed because we have the advanced decline line for S&P 500 did hit fresh all-time highs. So this is really good news. The advanced decline volume line has not. So the volume is lagging, and this is going to be kind of like a theme throughout today's review, because we see advanced decline line does hit fresh all-time highs, but quite often the volume is lagging. So how much does this matter? We will see in the near term. In general, I think this is a very bullish chart, obviously. Here's S&P 500 with a bunch of market breadth indicators, mainly the percentage of stocks above 200 and bullish percent index. You can clearly see a divergence now. In other words, we're making new highs in the index, but we are making it on less participation. Less stocks are participating in the advance. This could, correct itself. In absolute terms, I still think that these are very good numbers. We're about 60% for both of them. So this is still very good numbers. But I do see a divergence, and maybe it will eventually play out. Here we can see S&P 500 on the weekly time frame, and we now see a tentative breakout above resistance point 1. It's possible that we'll, push back down after this week. Maybe it was just a one-time thing. But for now, this looks legit, and this weekly candle looks quite strong. So we will take it at face value and assume that it is indeed a real breakout. The same goes for QQQ. You can see that it broke above resistance point 2. So it's a very, very strong move here from November lows. It's a very strong move, and then even from 2016 lows, pretty much non-stop, straight up. Kind of steep advance. You can see it is very, well, it is quite steeply overbought, I think, in my opinion. But overbought could be a good thing because it took a lot of buying to get QQQ up here. Here's QQQ on daily time frame again, and this one is pretty much confirming the advanced decline lines are confirming the fresh all-time highs. So I don't see any issues with QQQ. It's definitely one of the strongest of the bunch. A little bit same thing as I just showed before for S&P 500. Here's percentage of stocks above the 200 and the bullish percent index. Also, you can clearly see a divergence. It was very high readings to begin with. Back here in February, it was 89, 84. So right now we're coming down to 74, 70s. It's still very high readings. So still very good, generally very good strength. But there is a little bit of a divergence, and it's definitely overbought. But like I said before, we have become overbought on numerous occasions before, and we just continued being overbought. So overbought does not mean we're going to correct anytime soon. Here's a Dow Jones Industrial Average, also fresh all-time high, though it's kind of hard to see, but it is a fresh high. And here we can see advanced decline line also confirming the fresh all-time highs. The volume is a little bit lagging still, so the high is from March, and we have not seen fresh high from for Dow Jones in the volume. Here are the small caps Russell 2000 index IWM. So IWM hit fresh all-time highs in April and then sharply pulled back. In general, this is a very choppy chart. We have first attempt to go to fresh highs. It was sold. Another attempt, and then again it got sold. So right now, this is still not a very, I mean, this is pretty good looking surge, but ideally I'd like to see maybe a little bit more strength, because like look at this weekly candlestick. You can see that if it was something along these lines, it would be obviously much better, but it didn't. So it looks like we still sold off on the IWM. So just not my favorite, instrument to trade, honestly. But nevertheless, if you like to trade it, it is more choppy, but at the same time, you could potentially get higher gains. Here, the advanced decline lines are still, the advanced decline line did confirm the previous high in April, but the volume obviously has been lagging, and we haven't seen a fresh high in volume despite actually 2 attempts to go higher here. So just very choppy, I guess is the word. Here is a little bit longer term, same chart. Here we have pronounced divergences. We have fresh highs in the index, but we have divergences in momentum and market breadth. You can see a divergence in momentum here, price momentum oscillator, RSI. But I think the more important one to me is the percent of stocks above the 200-day exponential moving average, and you can see that we have been steadily dropping in that department. Can this change? Yeah, it can absolutely change and improve, but so far it hasn't happened. So it's not it's not a very appealing chart. It's very choppy. So XLK technology, very strong, fresh all-time highs. This one kept confirming, you can see advanced decline lines kept confirming the fresh highs. So this one I don't have any problems with right now. The only thing that I wanted to point out on this chart is this really weird enormous volume spike, and this is not visible on QQQ. The volume on QQQ on Friday was, just actually below normal. But on this XLK here, very unusual volume, and it's at fresh highs. So maybe we're seeing some selling up here. Who knows? XLI industrials, also very strong move, also confirmed by advanced decline lines, but not the volume. So again, similar theme throughout the presentation today. And here is the consumer staples breakout to fresh all-time highs. Again, very strong confirmation from both advanced decline lines and volume. Very, very good looking chart, one of my favorites. Of course, all-time favorite for me right now is utilities. Myself, I still have a position open, and we opened in MasterChartsTrading.com. We opened in November, and I just kept it open because there's absolutely no point to close it if the move continues. I was a little bit choppy here back in December, but it obviously has cleared that out. So utilities are leading, and this could be viewed as, you know, two ways. I guess one way you can say that maybe the market participants are saying that the interest rates are going to be staying low, so there's going to be plentiful liquidity, and therefore utilities are taking advantage of interest rates staying low. The other way to look at it is because, you know, this rally is being led now by utilities and consumer staples, and these two of them are both defensive. But at the same time, we have industrials and technology breaking to fresh highs. So it looks actually like we have a relatively broad participation, even though the staples are defensive and utilities are, of course, is defensive as well. So again, this could be interpreted in two ways: is that this could be viewed as a defensive rally, or it could be viewed as a genuine breakout to fresh highs, and we're going to see a continuation of fresh all-time highs for the general market. XLF financial still dragging its feet, and I want to spend a little bit more time on this chart. So if you just look at it from, you know, obvious thing, you can see it's a head and shoulders pattern. We retested, so far successfully retested April lows here in May and held support. So we bounced here from May lows. What I wanted to show again is the weekly candlesticks. Sometimes it's quite helpful to zoom out and look at from a little bit, you know, zoomed out view to see if you're missing something on a daily or even intraday chart. So here from the weekly perspective, this candle is obviously more bullish than the previous week's candle, but it's not great, and here is the reason. The close is, you can see 23.61, and the open here from last week was at 23.61. So you can see that there was no real breakout. Additionally, this could be thought as an inside week for XLF. So inside weeks could be a powerful, like, coiling up of the security, like a triangle consolidation. And if we say that we're now in a short-term downtrend, this could be like a triangle consolidation before a continuation lower. If only we had a close somewhere around 23, even 65, 23.70, I would say I think we're done correcting, but I cannot yet say that with 100% certainty. And additionally, if we look on a small cap side, so KRE, notice this weekly candle is just not great at all, or KBE, the bank index, same thing. So right now I cannot say that financials are done correcting, and when we get to bonds, I think we'll realize why that is happening. Finally, XLY, consumer discretionary, also relatively strong, and in fact it broke out to fresh highs even in April. We have more or less confirmation of that new highs and advanced decline line, so this is looking pretty good. Now, one of the consumer discretionary industry groups, the retail, if you may have heard, has been under tremendous pressure. So this is a weekly chart of XRT, the retail diversified retail ETF. Notice it has been just not behaving anything like the rest of the market. Whereas the rest of the market is moving higher, XRT just keeps moving lower and cannot get any kind of meaningful rally started. So we are actually approaching 52-week lows. I put in a 52-week weekly channel here. So 52-week lows are not far off, and if XRT starts hitting 52-week lows, that is not something you want to see in a security that you would want to, buy in. Maybe if you're trying to short it, that's a different story. If you're trying to do maybe options to play it on the downside, but it is still an important sector for the general economy. So I think XRT will really need to soon bottom out here and join the rally. Otherwise, I'm afraid this could be like a first shot by the bears, I guess. You can see that they've been quite successful in pushing the prices lower. Overall, again, I wanted to recap S&P 500 fresh all-time highs. So overall, I think it's generally a bullish picture. So I definitely would not be looking to short this chart anytime soon. Junk bonds. This is a daily time frame. This is an adjusted chart. In other words, this chart is adjusted for dividends. So with the adjustments, we're seeing all-time highs in the junk bonds. Notice that last week here on Wednesday, the drop was the selling was relatively muted, and then the next day we have this big white candle, very relatively bullish looking, with a follow through, and we just broke out to fresh all-time high. So what this is showing me is that junk bonds, first of all, they correlate highly to the general market. So the behavior of junk bonds in this case was like a first sign that most likely the bears would fail here, and they did so far fail. And here's the weekly time frame for the junk bonds as well, fresh all-time highs, and the move seems to continue, a very strong move of the February 2016 lows. So overall, stock market correlates highly to the junk bonds. So if junk bonds continue higher, I think the stock market would be in a good place to continue higher. Moving on to the treasuries, the investment grade bonds. So here, a few weeks ago, I pointed out presence of buying pressure. You can see buying pressure, big white candlestick, a gap, a little bit trading, another gap, and then we're maintaining both of those gaps. So there's obvious presence of buying pressure here. And even though stocks are moving higher, bonds are not moving lower. And usually stocks and bonds, move opposite to one another. Well, especially with treasuries and the long-dated ones, for that matter. So you can see TLT correlates quite strongly negatively with TLT. So you can see that most of the time bonds spend in the negative correlation territory, and occasionally they move together in the same direction. Nevertheless, here's TLT on the weekly time frame. Here we had 52-week lows, so that would kind of, I guess, disoriented me. Even those were all-time highs here for TLT. These were 52-week lows, and this rally, I was not playing this immediate rally, but we were when I saw that we are holding support here around March, then I started playing in TLT again, and I actually have a position open in TLT that we opened at MasterChartsTrading.com. That I currently have open. So once I complete the trade, I'll post it so that other people can see it. But this is a sort of like an insurance against stock market drops. Like I said, the TLT correlates negatively to the stock market most of the time. So here, last week and the week before that, we had a hammer candlestick on the weekly time frame, a big follow through, very nice looking candle. This week, the important thing is that we did not really drop much. which is kind of held in that area. Additionally, this is an inside wick, so if we break out above, we could have a strong move, and most likely if we break out above last week's week before that highs, so like above 124 here, most likely we will take out previous resistance at 124.72 here. Diversified bonds, AGG, this is a daily time frame. Here what I want to point out is a bullish cross. This is a 50-day going over 200-day moving average, so very simple trend following system, and many people use this as a guidepost. If the 50-day is above the 200, then they will be buying, and vice versa. So here we have a bullish cross. This will add to the evidence that bonds are continuing higher and most likely are still in an uptrend. This is a weekly time frame for AGG. In here in December of last year, we had basically a successful retest of breakout, and actually need to zoom out a little more because I wanted to show the breakout level, and here you can see it's pretty obvious resistance from 2015, breakout, continuation to fresh highs. Here we have very steep sell-off, but truly even at this point, when we had in November, December of last year, these were not 52-week lows, and I could not make a case that we were in a downtrend. We held support exactly at the breakout level, so this was a successful retest of the breakout, and then we continued higher. Now we're basically at resistance, but we may have already broken above the resistance on the last week's candle here. Finally, LQD, the investment grade corporate bonds, the bullish cross happened actually a few weeks ago. Same, lots of buying pressure here. Notice the gap, another gap. Notice those gaps here. So also held support from last, even though the stocks went to all-time highs, bonds did not drop, and this is what I think is important for bonds. And we're basically approaching all-time highs for LQD. We're just a few points away from all-time highs, and very similar pattern to the one that I just showed. Basically, we had a breakout here in 2016, pullback, and then a successful retest. So to summarize, I think bonds actually are bullish, and this could be signaling a little bit more caution for the stock market. So I would be possibly reducing my positions at the very least, and not going all in on stocks. US dollar in the daily time frame, so under pressure, sold off from multi-year highs here in waves. Finally here we had more or less a support break a couple of weeks ago, and we continued lower. Now it looks like we are attempting to bottom, especially the Thursday and Friday. Looks like a nice combination of candlesticks, and looks like we are attempting to bottom here. We still could retest November lows for the US dollar index. Now, generally speaking, I think we're still in a bullish uptrend for the US dollar. Here's the November lows from 2016. We're approaching those lows, but notice that this last week's candlestick is looking like a hammer-like candlestick. So this could be it basically, and we could just stop here and move higher. Long term, I still think we're in an uptrend. I think if we break November lows, then I would start to question this uptrend. But for now, I still think we're in an uptrend for the dollar. Euro didn't really do much this week. It definitely showed presence of strong buying. Notice there was a gap here in a weekly time frame from a few weeks ago, and then we kind of chopped a little bit and then broke out even higher. Now I question this breakout, and if I was if I played currencies, then I would be already looking to short this surge. British pound, pretty similar picture. Surge kind of moved slightly higher, but again, I would be already considering to short this potential breakout. I just think we're still in a downtrend. US dollar versus Japanese yen. I thought that we're basically done correcting here a few weeks ago, but we didn't, and now we again moved lower. So I guess we're gonna have to chop around some more before. I think the line in the sand here is about 114, or rather 115 or so. I think if we break above that, then the Japanese yen would continue strongly lower. But for now, actually, it's the opposite that's happening. The Japanese yen is gaining right now. Yeah, so we'll see where this goes, basically, right? There was not much that happened in the currency universe throughout the week. Gold on a daily time frame. This is a continuous contract. So I think this is a bullish chart, and now there's more bullish evidence. For example, here's a 50-day moving average going above the 200-day. So there's a golden cross. I pointed this one out last week. This Friday's gain was very impressive, and looks like we are breaking above previous May highs here. So this could be, maybe this is like a flag, and now we have a flag breakout. If this is indeed a flag breakout, and I'm going to show what I mean, the flag is like that tall, and then this is a breakout. Maybe if this is indeed a flag, we could easily re-challenge April highs. So in other words, 2017 highs could be easily re-challenged in the weeks ahead. If that's the case, we could continue continue higher actually. Here's GLD, and this is just a little bit different chart, but the gist of it is the same, and you can see a gap and a breakout above previous May highs. Weekly time frame, this is a really good looking candlestick for gold, and 3 weeks in a row we have continued gains for gold. So this is looking quite bullish, I think. And again, we could break out above. If we break out above April, there is obvious resistance up here from November highs, but these are 52-week highs, so we could easily re-challenge them. GDX, Gold Miners ETF. So some of my proprietary indexes, Gold Breadth Index improved dramatically from being very close to being in a bear market just in April, and we improved dramatically, and we're now clearly in a bull market. 4 is the highest it will go. Here what I wanted to point out is a bullish divergence. Now, what's a bullish divergence? And this is a lower high here for GDX from May highs relative to April highs. But notice that the advanced decline volume line actually made a higher high for that same time period. So this is a bullish divergence, and this is actually good. I do like to see this kind of thing on a bullish chart. I think this GDX is bullish. I like to see those kind of thing on bullish charts, because this means that there is the breadth of the stock of the market is leading the actual index, and hopefully we'll see a move higher by the index. Notice that there was this big white candlestick here on Wednesday. So I think what happened here is we had this initial surge, kind of like an evening star pattern. Several, big red candlesticks. I think the market players that were trying to shake out the weak hands, they did so on Wednesday here because they pushed the prices lower. Many of the stops were hidden below 2250 here, so they took out those stops and rallied. This is looking good, and I think we could continue higher. This is a very bullish candlestick right there on Wednesday. Some more of my Market breadth indicators, again, gold breadth index. This is GDX on a daily time frame. Here we have a percentage of stocks within the index on a buy signal that finally hit 100, and this is a bullish trigger. And notice that we had a bearish trigger back here in October of last year, and we were not able to regain that distinction until now. So this is another piece of a puzzle and definitely a good sign. Another set of indicators for market breadth. Notice that we are moving again in the right direction for the bull market. Now we are slightly overbought here, but as I said before, for a bullish security to be overbought is normal. It is when the bullish security is oversold, you should look for buying opportunities. So here is an oscillator that I created also. It's a breadth oscillator. So it's basically a oscillator of the advanced decline line. It's ITBM. You can look up in chart school. You can find ITBM. So intermediate term breadth momentum oscillator. It's quite a useful indicator. It's a version of McClellan oscillator, but there is no ITBM for GDX on StockCharts.com, so I had to create my own. So anyway, so very useful indicator, I think. This just shows that oversold, overbought conditions. Here we had in beginning of January, February 2017, notice that we were around 5.6, but notice that the rally continued and continued strongly and for a while longer. So we're currently around 5.6. We're not terribly overbought as we were back here in April. So we're about the same levels as we were here in beginning of 2017 in January. So we could easily continue higher from here and possibly re-challenge the highs from November and February. Now there is strong resistance up here, but as I said, I'm seeing a bullish divergence here, and this means that the participation is quite good actually, and we could easily take out those highs if all goes well, and especially if the dollar continues to be under pressure. And finally, here's that same resistance on the weekly time frame around 25.70 to 25.80. So that is going to be an important level to watch. Now, there isn't much happening in the natural gas market, so I decided to spend a little bit more time on oil this week because it's just more interesting at this juncture. So West Texas Intermediate continuous contract on a daily time frame. If you listen to my videos, previous videos, I repeatedly mentioned that this rally basically is a counter trend rally, and I was looking for a failure. Now I'm a little bit surprised that it came here. I was expecting it a little bit higher. Nevertheless, looks like this is a genuine failure. We had a very strong selling here. This is about 5%, I believe, or so. So it's almost 5% selling in just one day. Now on Friday we did recapture some of those losses. So for a weekly candlestick, it's not the most bearish candlestick out there, but it is also definitely not bullish. So overall, if this candlestick was closed a little bit lower, I would be even more happy. But nevertheless, we have to deal with with the cards we're dealt. So we may actually bounce a little bit around because this was very big red candlestick, and it definitely was like an oversold condition on a short term, and then obviously we rebounded. So this short-term oversold condition most likely has already been relieved, and the shorts are definitely going to are definitely taking advantage of this basically right now. Notice we had something along the same lines here. We kind of just unraveled from the previous resistance highs. Now again, I'm surprised that the resistance came in actually below the pivot point. I was expecting it at the pivot point and maybe slightly higher, but you know, you never know what's going to happen in the markets, obviously. Long term, I maintain that oil is in a downtrend for various reasons, but I'm not a big, into fundamentals research, but fundamentally, I think oil is in a downtrend for the fundamental reason because there is overcapacity of it. There is just so much production of oil that the prices are dropping as a response to that. It's a simple supply-demand kind of business. So some more evidence to this are in the energy producing sector, and here's XLE. Notice that when the rest of the market is hitting fresh highs, and the advanced decline lines for that matter are also hitting fresh highs, the advanced decline line for XLE and advanced decline volume for XLE are hitting fresh lows. There's a multi-year lows and 52-week lows for the advanced decline line. Also, we are approaching lows for the year for 2017 for XLE. And I mean, this Friday's candle, maybe this is like a hammer, but it's a really small hammer compared to the ginormous red candlestick. Here's a chart I showed in the past. This one just shows that energy seems to lead oil. So notice that energy ETF moved lower before oil sold off finally here in 2015, and looks like that's exactly what's happening again. Looks like energy is selling off, oil is kind of moving sideways down, slightly up. You know what I'm saying? It's kind of just slowly moving down as well. Now, if past is any indicator, we could see another strong plunge for oil, possibly to the 20s. But I guess first thing first, and we need to take out the first resistance, support rather, at easier to see here, it will be around 40 to 20. So XLE is not yet in a these are not yet 52-week lows, but we're definitely approaching that. Price channel. So I'm going to put 52-week price channel. So I just show you what I mean. So we're approaching 52-week lows. We're not that far off from 52-week lows. And again, when the security is in at 52-week lows, quite often it gets sold strongly. For example, here is the target, I believe, got sold off quite strongly. Notice that how it hit 52-week lows, bounced slightly, and then just continued to 52-week lows. So if when XLE hits 52-week lows, I think we'll see something along the same lines. In fact, here is another oil-related XES. They are already at 52-week lows, and this is not a good sign. So I wanted to show some of the headlines from Wall Street Journal. This has to do with fundamentals. Very good and thorough research. Again, I'm not claiming that I know much about this, but this is interesting to keep in mind as a fundamentals. So another relatively new term is peak oil demand. In other words, what I understand this means is that we're reaching a point in our civilization history where oil is not going to be as relevant as it used to be. Reason being is we have other technologies to generate energy from, for example, solar, wind, etc. And additionally, we have, for example, electric cars and other disruptive technologies that are contributing to this, especially horizontal drilling, shale oil, and things of that nature. But here what I wanted to point out, what's kind of interesting is that This is a International Energy Agency, one of the kind of big players in this world. So some of the scenarios they're saying could be that peak demand for oil could come as early as 2020. And notice this is already 2017, so we're could be already approaching peak oil currently. So I wonder if the weakness in the oil sector, pervasive weakness in the oil sector, collapse of oil prices are already reflective of all of this assumptions. And especially European players, BP, Statoil, Total, they are already making kind of a transition to other energy producing equivalents. For example, they're trying to move to more lower natural gas. There is investments by the energy firms into solar and wind, etc. So this is a very interesting time, and I think it could be very disruptive for old-style energy companies. Another article there is that basically a few years ago, when Saudi Arabia decided to continue pumping oil without any kind of cuts, United States producers said that they were able to deal with the cuts by cutting prices and figuring out how to basically streamline their operation. So right now, many of United States shale producers can produce oil at very low cost, even below $30–40, and this is making OPEC very worried, obviously. So they're cutting production. And if you think about it, if any kind of commodity or any kind of supply demand, if you're trying to cut production, that means you have overcapacity, and that means prices will drop. It's pretty straightforward. Now here's a very interesting piece of the puzzle. BlackRock and Vanguard, two of the biggest, BlackRock is giant and an asset manager, are strongly considering public rebuke to ExxonMobil over climate change at the annual meeting next week. Now the important thing is that I think this statement here, shareholder proposal would push oil company ExxonMobil for a climate stress test gauging impact of green technology on its assets. So what does it mean? This means that solar especially is becoming extremely cheap, and producing a kilowatt equivalent of electricity from solar versus by burning fossil fuels is becoming, well, very competitive. In fact, how competitive it's becoming is becoming extremely competitive because, for example, here is in India, they canceled a power plant, coal power plant, because solar energy prices hit record low. They're basically collapsed. The reason being is because the solar panels are becoming extremely cheap, and they're also very productive. Now, there is improvements in the production of electricity from solar panels. I've read about that. Solar panels now can absorb or convert not only visible light but also infrared light. So even if it's cloudy, solar panels can still produce. Now notice that what's happening to the price of ExxonMobil, because this is a technical analysis website, so we should kind of stick to that. And notice that ExxonMobil is at 52-week lows. Again, this is a weekly chart. So as I said before, when a security hits 52-week lows, it is usually not a good sign, and most likely we will see fresh 52-week lows. ExxonMobil is still one of the biggest companies, but look at this price to earnings. I think it's if we see a BlackRock and Vanguard decide to publicly rebuke ExxonMobil, then I don't see why the prices would stay this high. All right, that's it for this week's recap. If you have any questions, comments, please do share, do write your comments below. Please hit the like button below for this video, and of course share this video with others. Please stay tuned on how to find us on the internet at MasterChartsTrading.com. Thanks for watching and have another great trading week. Bye-bye. So I wanted to show you how to find us on the internet. Please go to MasterChartsTrading.com. We do have a trade alert services which are live right now, so please consider signing up for the service. It's only $24.95 per month. Also, if you sign up for our mailing list, you get a discounted membership. You get to see what I'm buying and selling and which funds I'm looking at, potential buys, sells, etc. There's quite a bit of members-only content once you log in. There's a lot of information about risk control, which is actually extremely important for traders, because the preservation of capital is really one of the paramount to the success as in trading. There's quite a bit of psychology of videos, psychology of trading videos in the members only section as well. Also, I'm going to be starting a Dividend Aristocrats service. For now, it's free for the members that are logged in, that are already paying members, so that's another benefit to signing up soon. The blog section shows the previous posts and market videos, of course. Also, I've added a new section here, which is FAQs, and I do get quite a bit of questions about various, ideas and questions about the market. So if you do have a question, please don't hesitate to send it in. Send it here, and I'll be hopefully I'll be able to answer it for you. All right. Thanks for watching, and please consider signing up for the trailer services. Bye-bye.